And in part two, we're going to talk about the loan, a loan presentation, and kind of what goes into risk and risk scoring, and um, how a borrower and how a financial institution look to keep as much risk out of a loan application as possible. And then we're going to talk a little bit about how financial institutions and borrowers try to reach a mutually beneficial loan structure, and then the difference between conditions, covenants, and commitments. So we'll get to that. But the first piece is really about, there's parts of credit, and the first part of business lending credit is cash flow. So a lot of times when I get calls from borrowers, they talk about collateral first. And what we like to do is we like to look at cash flow first. So there's two types of cash flow. And there's kind of what I call transactional cash flow and then global cash flow. So think of it this way. If you had one van, and that van was for your business, and you were transporting people around, and they were paying you, you were paying your van loan and all this kind of thing, any monies and profit generated by that vehicle, because that is the tool of your business, that is the cash flow of that transaction, that business. But financial institutions also look at globally. So let's say that your business, your transportation business, is breaking even or maybe a little bit more, and you're going to go, you're going to grow, but um, you decide that you're going to move into some $1 million palace, and hey, if you could do it, great. But what you have to remember is that all of your household expenses, financial institutions are going to look at as how that would impact the ability for your business to run. And also what you're looking to borrow for how that affects you in other ways. So that's kind of a global view of cash flow. So we want to make sure that your cash flow is adequate. And people always ask me, well, what's the magic number? So typically the magic number is 1.25. So if I was running a business in my life at break even, I would be at 1.00 or 1 to 1. So for every dollar I have coming in, I have a dollar going out, right? I'm still covering all my expenses, all my bills, but I don't really have a lot left over. So what financial institutions like to look at is a little bit more of a consistent cushion between how many expenses are going out and how many dollars are coming in. So usually, for every dollar out, they like to see $1.25 in. So some people call that 1.25. However, whatever language, it doesn't matter. It's all the same. But that's kind of the cushion for cash flow that most financial institutions would consider a minimum. Now, character does play into it. And, business loan officers, they move from bank to bank and they talk to people about other deals and get referrals. There's some banks and credit unions that they do certain lending and they don't do other types of lending. And so they'll talk to financial institutions that do the kind of loans that they don't, just to try and help out their members. And so the character of a borrower is important. And then capital, the amount of cash that the financial institution is going to evaluate is part of the borrower's risk at failure. So do they have some fallback money, rainy day funds, those kinds of things? Do they have adequate capital if there's a risk at failure? And then after that, we look at collateral. It's important to know that, yes, collateral is important, but certain types of collateral are not worth what some borrowers think they are. So, for example, let's say I have a borrower and a borrower says, well, I've got $1 million in the stock market and I'm going to pledge that as collateral. Well, a year or so ago, maybe 2 years or so ago, that portfolio might have been worth $1 million. But if you were to evaluate the portfolio today, maybe not so much. So that type of collateral, a lot of financial institutions won't take, or they'll take at what they call a discounted rate. Or if I have a pizza oven and, it costs me $20,000 to buy it, the if the financial institution had to take that back and sell it, what is that kind of value? So different financial institutions look at collateral differently. So you just have to have those conversations. And then conditions. What specific benchmarks is the financial institution going to look to the borrower to get? Strengths, weaknesses, all of that stuff is going to go into your business plan. And then sometimes those conditions will affect how the financial institution evaluates your credit. Okay, next slide. One of the things that the reason why I like to talk to borrowers in this session is I always try every week to emphasize the mutually beneficial structure. So a good loan is not to the bank's advantage only, and it's not to the borrower's advantage only. It needs to be both. All right. And so here's how financial institutions try and get there. So there's a thing called amortization. So it protects the borrower's cash flow ability. So how that works is, let's say, for example, you wanted to buy a investment property. And let's say that investment property was $100,000. Well, if you were to say, okay, I'm going to pay that off in 5 years, your payment would be very, very high. And because your payment would be very high, you might not show enough cash flow to repay the debt. So what they do is they amortize that out. And let's say that's pretending, so to speak, that you're paying on that loan for 15 or 20 years. Well, now all of a sudden, the ability for your cash flow to service that debt is more reasonable. So that's how we protect the borrower's cash flow. Now, the term of the loan protects the lender from market conditions. So let's say, for example, the loan officer says, okay, we'll amortize that out 15 years, but your term is in 5 years. And so what that means is you're going to make payments for 5 years. And then depending on how that goes and how your position is, you're going to renegotiate that loan, or you're going to refinance that loan at the end of that 5-year term. Now, why do lenders like that? A couple of reasons. Look at the last 12 years, what interest rates were like, right? They didn't move off zero hardly. Very, very inexpensive to borrow money. And then in the last, 6 to 12 months, you've seen the Federal Reserve raise rates. Lenders are raising rates. And so if I'm a financial institution and I was lending out money at 3%, I can't do that for 15 or 20 years because I have no idea what those market conditions are. Because now, if on the 5-year term, we're going to be looking at, let's say rates are now 6, 7%, which is still inexpensive money, but that's kind of where the market is today. So that protects the lender, the term does. And then there's also this, we talked a little bit about the SBA. So conventional loans versus SBA. So the SBA, a little more paperwork, understandable, but they have this guarantee that protects the lender. But they also have, sometimes they have some extra fees and those kinds of things where conventional loans don't. So a good business banker will be able to have a conversation with you about both sides of that fence. Conventional loans versus SBAs, why it's good, why it's bad, and then you both make a decision as to which road you want to go down. And then there's another, and this is all born out of regulations by financial institution regulators. This idea of what is a business loan and what is a business purpose loan. So typically $50,000 is the magic number. There are also regulators that will consider certain types of loans, mostly in the real estate area. They'll call those business loans versus business purpose loans. So typically, though, $50,000 and less, if that's what you borrow, if they call it a business purpose loan, there's a lot less paperwork and a lot less kind of annual checkup with you for that dollar amount. I mean, think of it this way: you can't hardly buy a new or even recent new used car much less than $50,000 for something nice. So when you get that loan, as long as you're making the payments, the financial institution never asks you, hey, let's relook at all your financials this year and see if we're going to still give you that car loan. So business lending is starting to go that way too, where certain dollar figures they won't bug you as much. All right, so out of those things, then once the financial institution talks to you about, well, what's mutually beneficial, then they will evaluate everything else in the paperwork that you've given them that was out of part one of this series. And then they're going to give it a risk score. Now, a 1 is to 10 is pretty typical for a kind of scale. 1 being excellent, 10 being we can't lend you any money. But most business loans kind of fall in that 3 to 6 category as a rating. There's, if you're a 1, you probably don't need the money anyway. If you're a 9 or a 10, you're never going to get the money. So that kind of scoring from 3 to 6 is very typical for business loans that get approved. And a lot of things go into that scoring. First off, the ability to pay your debt. We talked about the difference between transactional and global. Credit scores. Credit scores of the borrower are a factor. Loan to value. So let's say, for example, I have a $20,000 pizza oven, but I only need $5,000. The other $15,000 I have in cash. So the risk of the loan and the collateral value is low. Now, if I had a $20,000 pizza oven and I needed $19,000 of that, then of course the loan to the value of whatever you're buying is a lot higher. So that affects the score. And other financial ratios. So every single financial institution has a different way to score your risk. And so you have to be willing to have those conversations. What financial ratios go into your scoring? Where did you score me and why? They should want to have that conversation with you. And then profitability of the business. Now here's an interesting piece. If you're a new business, the first thing you're going to say is, well, I don't have any profitability history. Well, okay, that's true. But let's say, for example, you're in an industry or you're starting a business that has some very similar businesses or affiliated businesses. The financial institution can look at that and say, okay, we kind of get what this business is because we see it over here, or we see parts of it over here, and we know how that typically operates. So they can look at things that aren't necessarily your business when it comes to that. All right. Now, one of the things that a really good business banker will explain to borrowers and explain to the people that are listening to the loan presentation to get approval is this idea of how are the barrels full of risk or how are the barrels empty, meaning no risk or very little risk. So I'm going to try and break this down in the next couple of slides, but stop me if you have questions. All right, so you look at the barrel on the left. All right, on the next slide,
Excuse me, I have a quick question.
Oh, go ahead.
Please go back to the previous slide.
Juan Carlos, for some reason I'm having a difficult time hearing you. Maybe you
Can
need.
you hear me? Can you hear me better now?
Oh yeah, much better.
Could you please go back to the previous slide and provide some examples of other financial ratios, and also um, I see debt service ability outlined, so that's where like collateral comes in, like property and assets, or are you talking about liquidity, or are you talking about like other aspects of a business that might play favorably when being considered for a loan by a financial institution?
Yeah, so on the other financial ratios, let's take an easy one. Let's a lot of financial institutions evaluate um, um, like your net worth, okay, or they evaluate, they look at your personal financial statement and they look at, what is your debt to income ratio, those kinds of things. So not every lender looks at the exact same things. So I just kind of put that in as just a general. They will look at other ratios. As far as um, collateral, you were asking about collateral. The loan to value is very important on the collateral, and that could be objects, that could be real estate. Obviously, the less you have to borrow against a greater value, the more, the less risk that there's going to be. And then the last thing you asked was about assets and capital. It just it really depends on if you're going to pledge those or if those are going to go in what we call a blanket UCC filing, which we talked about last week, where some financial institutions will use what they call the abundance of caution clause, and they will kind of blanket all of your assets and all of your belongings as kind of an umbrella of collateral.
So, Juan Carlos, does that help?
Yes, and just one more question. When in regards to the score factors, um, let me see. What about the background of the business owner? Like if the business owner has a criminal history, would that play? I mean, is that something that would be also? I mean, I would assume it would play a role, but is that something that would be evaluated at some different?
Yeah. So when you start talking about the character of the borrower, that all comes into play. Clearly, if you had problems with SBA backed loans, that might not even be an option if you've had some default issues with them in the past. If you've had bankruptcy issues, um, most financial institutions will want to know that story and understand why that happened, those kinds of circumstances, and then if they can work through that, then they will. But yeah, we definitely look at those things.
Yes, I would assume that if someone has a felony charge in its background, that would pretty much preclude that person from pursuing certain types of funding, if not most
Um,
loans.
so look at the thing about felonies is um, look at even SBA. Okay, if you do a statement of personal character, I think that's a 912 form or something like that. I can't remember off the top of my head, 1912 or something.
Oh
I've actually done SBA loans with that statement of personal history disclosing that felony that they approved after doing some due diligence and having some conversations with the borrower. So it's not it's not a deal breaker all the time. I mean, I've seen the SBA do those deals.
So, chances are that SBA probably wouldn't do a deal where the felony was financial related. That probably would preclude you, but otherwise, there are some felonies that they will allow to go. The other thing I wanted to bring something up on ratios. So We use a financial template for startups in particular, but it can be ongoing businesses, and that actually will calculate some financial ratios based on the input that we put in there. And then I know that there are probably banks that I would think use RMA, which is Risk Management Association, and you can actually go out online and based on the industry that you're in, be able to get ratios on various aspects of any given business or industry based on, I guess you would base it on revenue. So in other words, you'd look at $1 million business or a $500,000 business or maybe a $50,000 business, and risk management is a database. They track all that stuff, so they'll look at companies that are out there and track those ratios, and banks can actually compare the ratios that you're forecasting versus ratios that are out there through like RMA. And that database exists if you ever want to look at it yourself in the Cleveland Public Library, the only library that actually has access to that database. So,
Thank you.
All right, so let's go to the next slide. So we're talking about how does a business banker look at your application in a loan presentation and try and get it approved. So if I were to say to the business loan committee, well, this loan application barrel is full of risk, what I would mean is on the left. So first off, it takes a whole bunch of loan dollars to get to the first red line. Okay, so the loan request is high. And then the gap between the loan dollars that are in that barrel and what you're going to bring to the table, kind of your investment in the deal, there's not a big gap there. Okay, so you're not bringing a lot of kind of first money in, so that increases the risk in that barrel. And then if you look at the debt service line, the top line just barely covers the top of the barrel. So what that means is we were speaking earlier about the difference between being 1-to-1 or dollar in for dollar out and being a dollar out and $1.25 or more in. So if your debt service barely covers the barrel and you don't have a lot of equity or loan to value, and your loan dollars are high compared to what else is in that request, there's a lot of risk involved in that barrel. And so when there's more risk involved, then your score will slide to the right. So instead of being in the 2, 3, 4 lane, it might be in the 5, 6, 7 range. Okay. So now on the next slide, if your loan officer goes and takes the presentation and says, well, there's not much risk in this loan request, this is what it would look like. Next slide. Oh, here we go. Okay, so first off, the first red line, the loan dollars. So compared to what you need, the request for the loan is low. All right, compared to the one on the left. Then the next line, the equity or the collateral value, there's a large gap. So that means that either there's a lot of value in the collateral or you're bringing a lot of your money into the picture. Okay, you believe in the deal, you've saved up, you have some equity to put in, and so you've kind of separated that there. And then the debt service, see how the debt service is completely covered the barrel, all right? And it's over the top. So you have plenty of money coming in to support the debt that's going to be going out. So when we look at scenarios based on the left and based on the right, the ones that look more like the one on the right are typically the ones that get approved and funded very fast. Very low risk scoring, very easy for financial institutions and their business loans committees to approve. Now, we've talked a little bit about the SBA effect. So if you decide that the SBA is the right road to travel down, and sometimes it's the only road to travel down, then the next slide shows you what happens. So you see this big shaded area? Think about that as the guarantee from the SBA. Like we said before, the SBA is not the lender. But what the SBA does is they say, hey, we want small businesses to survive and thrive. So if you would do this loan, credit union or bank, but you would only do it if we guarantee the loan in case of default, we'll give you that guarantee because we want to take as much risk out of the barrel for you as possible to get you to say yes. All right. So it's not 100% of the loan. Okay. Usually it's between 75 and 80%, depending on the type of SBA loan it is, 7As, 504s, sometimes or less. So, but that's what the guarantee does. So even though there's more paperwork, sometimes there's more fees, there are some advantages, and this is a big one, is if you have a barrel full of risk on the left, an SBA can make that go away in the right circumstances. Okay? I hope that makes sense. All right. So you evaluate, your business loan officer has evaluated it with you. He has taken his loan presentation to the committee. Now, there are certain financial institutions that don't need a committee for loans under a certain amount. We talked about that $50,000 magic number. Some branch managers might even have the ability to go up to $200,000. You have to figure that out when you have conversations with your financial institution. But for the most part, most financial institutions will have a business loan committee. And that committee might be the CFO and business bankers or other people in risk, in their risk areas, those kinds of things. And the committee will vote, and they will vote based on, okay, this is the information that the borrower gave you and you brought to us. We've scored it, we've reviewed it, and now we're going to vote. Okay. And so they might say, well, yes, this is yes for now. Okay. So sometimes when they say yes, there's strings attached. Okay. And the loan officer is going to have to come back to you with those. We'll get to that in a minute. But a lot of times when they say yes for now, they're going to want to know, are there going to be conditions or covenants? So here's the difference. A condition is something that they might put into the loan documents and they would like you to do. Or they may discuss with you, hey, this is one of the conditions of the loan. Do you agree to that? Okay, those kinds of things. Conditions are a little bit what I might call softer. Covenants are not. Covenants are going to be in your loan documents and they are a must-do statement. So covenants are very serious because if you do a review of your business loan and you break one of the covenants that's in the loan, some financial institutions will consider that a condition of default. All right. So if you don't cure that fault, usually within 30 days, then they can do things that are spelled out in your business loan, like call the loan or change your interest rate to something higher, those kinds of things. So you need to make sure that you understand if something they're asking you for the yes for now is a condition or a covenant, because that makes a big difference. There's also costs involved that they might say, okay, look, we like this deal, but we think we need to have a certain type of environmental assessment done, and that's going to have cost, and that's not going to be the lender's cost typically. And then there's a commitment letter. One thing I talked about last week is the difference between a pre-approval and a commitment letter. I don't like it when financial institutions tell people that they're pre-approved based on not much information. And then when they actually give the commitment or the offer to the borrower, it's completely different, or it might just be no. hey, yeah, we thought we had a pre-approval, but we looked at all this stuff and we scored it, and the committee said no. All right, so the commitment letter is kind of, it's like the agreement between the borrower and the financial institution that here's all the terms and this is what's going to come next. So knowing that there is such a formal thing is important. And then they might say, okay, we would approve this deal, but we have to get the collateral appraised. That's pretty common. And then we talked about the legs of the stool last week. And of course, they would say, yep, we would approve it. And as long as underwriting approves it, we're good. So underwriting is a whole nother thing that we're going to get into mostly next week. But they kind of have some different standards too. And then participants. So here's a scenario. Let's say, for example, that you like a very small credit union. You've done business with them, but you want to buy 100 vans for your business, and that's going to cost you $1 million. Well, that credit union or that community bank, smaller, institution might say, you know what, we like this deal, but I can't lend you all that money at one time because, I'm a small shop. So what they might do is they might look to other credit unions and say, hey, I've got this $1 million deal that really looks good, but I want to know if you want to invest $500,000 into this loan with me, and I'll take the other $500,000. Now, to the borrower, that's still $1 million, and you're going to make your payment where you were going to make it anyway. But those kinds of scenarios happen. Now, typically, those scenarios happen more often in really big real estate deals. But sometimes financial institutions have to look at other financial institutions to put deals together, and that all happens in the background. Okay, so they might have to line up participants to get your approval. Now, if the committee said no, here's a couple of reasons why they might have. One, you might be a 9 or 10 risk score, okay, and they just don't see a path forward. Or they might see a path forward, but it might take you a year or so to work with SCORE or whatever to get that ship righted. Or they might say, well, we have some concentration risk issues. So here's what that means. So one, let's say you've already borrowed money from that credit union and they are concerned that you as an individual person and your business is borrowing too much money as one person or one business, one member. Okay. So they might say, well, we're at the maximum that we can give any one borrower, personal or business. That does happen. Or the dollars category. They might say, you know what? I have as much money in my commercial vehicle portfolio as I want to take on. I'm not going to add any more loan dollars to that category. The next one is the industry NAICS category. So the NAICS category is kind of, hey, we aren't going to lend into this industry. So the thing that I see a buzz about now is people who are in the marijuana business looking for lending options. So people that have dispensaries, grow operations, Ohio licensed, those kinds of things, CBD oils, those kinds of things. Oh, sorry, I dropped. Anyway, so there might be financial institutions that just say, hey, look, we don't want to be involved in that industry. So they might say, hey, we don't have an appetite for that. And then lack of participants. If you needed that $1 million and no other participant would say, yeah, I would invest in that. And it's just too big of a loan for one financial institution. Okay, reputation risk. So if the financial institution thinks that there's reputation for the rest of their members if they do a loan for you. So let's say you wanted to open a casino or a speakeasy or like a marijuana dispensary. That's a pretty good example. There are financial institutions out there that just won't do it based on what they think would be a reputation impact or potential reputation impact. The analysis of your strengths and weaknesses, maybe they don't concur with those. collateral or appraisal shortage. So, you know, if I had that rental property and I thought it was worth $100,000, but it's really only worth $50,000, then you know, obviously there's a shortage in that. Environmental issues. If you were looking at buying a property that was an old dry cleaner or an old gas station or those kinds of things, and they're not satisfied with your environmental research or their phase ones, they're not going to get in chain and title with you. And then also SBA ineligibility. So there are certain franchises, for example, that the SBA approves and not approves. I gave that example of that women's fitness franchise called Curves. You know, that's an ineligible business for the SBA. So the committee will give an answer, yes or no, and there's a million different scenarios. Like I said in the first week, no two business loans are exactly the same ever. And so you're allowed to, go back one. You're allowed to, you know, I challenge you to ask the questions. If your business loan officer says, well, hey, the committee said no, just challenge and where was the shortfall, where, you know, and see if you can work that out. So then the next steps, though, if you get the yes, and we're going to go into this next steps next week. But first off, understand and negotiate the terms. So the commitment letter is kind of the blueprint for the rest of the loan application. So understand what the financial institution is offering, understand what you need, and make sure that it's mutually beneficial and the terms for that are agreed. There's nothing worse than thinking you're getting one thing and for both parties, and then having a problem way down the road with the terms that you thought you understood. Conditions and covenants, make sure you know the difference between the two, if there are any. Sometimes there are none, and that's great. And then, of course, get the commitment letter in writing. Make sure that the financial institution, you know, they sign it. Like, here, if we get past the next phase, this is it. This is how it's going to close. This is how the terms are going to be. This is what's going to be in the business loan documents. And you're going to sign that also saying, yes, we're moving forward. I agree. Because you don't want to get into a situation where you're trying to go as fast as possible to get the funding, and then you want to negotiate, you know, the day before closing. That's typically not a good situation for the borrower and the financial institution. Okay, so typically when you get the yes for now, everyone gets excited, but every commitment letter I've ever seen always has the following thing in it. So on the next side, I affectionately call underwriting the dream killer. Now, the only reason I say that is it's a real live person. There was somebody that I know who used to be in commercial banking, and she was in their underwriting department, and that was literally her nickname. She was called the dream killer, and I affectionately call her that when I see her. But underwriting is something that will be in the commitment letter that says, hey, everything looks good. Here's the terms. We're agreed. We just have to make sure that underwriting approves it the same way that we look at it. Okay? And we will discuss that at length next week and figure out how to get through underwriting and get to yes. And then after we get to yes, we talk about approvals and timelines and term outs and reviews and renewals and just kind of this whole life after funding. So that is a fun part of business lending. Like I said before, it's a relationship business. It's not something where, you know, you're going to get a loan and then you're never going to hear from your business banker again. It shouldn't be that way. You should be working to evolve your business and your business model and your lending needs as you go. So we're going to talk a little bit about life after initial funding next week. So at this point, I will open it up for questions or chat if it's working. I don't know, but fire away.
I think the chat is working, but everybody's mics are open and allowed to talk. So all you have to do is unmute yourself. Hey, Wally, how are you? Haven't talked to you in a long time. Hope things are going well. Any questions? Juan Carlos, anything that wasn't answered that you'd like to learn about?
No, so far so good. I mean, I'm really enjoying this series, and I'm looking forward to the next installment.
Good, good. So, go ahead, Dave.
Yeah. All I'll say is, you're not limited to asking questions right here. Typically, when I sit through these things, I usually have a question that pops up in the middle of the night, and feel free to email me, or and I'll try and answer it before next week. And if not, I'll look forward to seeing you next week and finishing up the series. I appreciate everybody's time.
Thanks, Dave. Thanks for doing this. Appreciate everybody. Take care now.
Thank you.
You are
See
very
ya.
welcome. Take care. Bye-bye.